For years, the Canadian Securities Exchange has been something of a force in the cannabis industry. The exchange that said yes when others wouldn't. At a time when cannabis companies were being turned away from traditional capital markets, the CSE opened its doors, giving a nascent industry access to the financing it needed to grow. And when US operators found themselves locked out of American exchanges due to federal prohibition, it was the CSE that stepped in, becoming the listing home for some of the biggest names in American cannabis. That history matters. Capital is what turns ideas into companies, and the CSE's early and continued commitment to this industry helped shape what cannabis markets look like today on both sides of the border. That's the foundation we're building on with this new segment. Cultivated and the CSE are partnering to bring you an ongoing conversation about cannabis and capital markets, the companies, the deals, the strategies, and the forces shaping publicly traded cannabis. And we're starting where any serious conversation about cannabis capital markets should start, with one of the industry's most consequential companies, SNDL and their CEO, Zachary George. And we're doing it from high atop the Toronto skyline at the Canadian Securities Exchange. With that, let's get to it. Zach, thanks so much for being here.
Thanks for having me, Jay. It's great to see you again.
Great to see you. This is the inaugural episode that we're doing from the Canadian Securities Exchange. We're glad you could be our very first guest. And before we sort of dive into it, to me, it seems like SNDL is a genuinely, let's call it unusual company, a nearly $1 billion business operating across liquor retail, cannabis production, and a significant investment portfolio. How do you describe what SNDL is to someone encountering it for the first time?
That's a great question, Jay. So we look like a regulated products holding company, but we are a vertical operator in the cannabis space with one of the largest alcohol retail portfolios in Canada. I think that's the apt description.
And do people shake their head, yes, that sounds interesting? Or are they like, how come nobody else is doing that?
I think you're really well aware of the challenges and headwinds that exist in the regulated product space, whether it's changes in consumer tastes and trends or regulatory hurdles. And so we spend a lot of time educating the investing public as to what our model looks like, what the playing field looks like generally for our competition, which models are successful and how things are evolving. The reality is if you zoom out, on the cannabis side anyways, you're seeing more consumption of cannabis in various forms around the planet on an almost daily basis. Beneath the surface, there's a lot of dysfunction and challenge. And it's been a real struggle for companies. If you look at the equity markets, we're basically sitting in sort of a 6-year bear market. So I would expect, more attrition, more consolidation, and some very, very healthy scale players will emerge. But we're still in the early innings here of the broader rollout of this industry globally.
Yeah, it seems to be. And even though you've been in it a while and I've been in it a while, it's hard to believe we're still in early innings because I feel like I'm growing old by the day. But I want to sort of dive into some of those things because on the cannabis retail side, you operate really under two banners, Value Buds, which is really difficult to miss if you've traveled around Canada at all, and Spirit Leaf. Yep. And on the liquor side, under Wine and Beyond and Liquor Depot and Ace Liquor. These brands, I want to ask you, serving sort of different customer segments, how do you think about brand strategy across such a diverse portfolio across two different sort of verticals?
Yeah, thanks. They do serve different customers, and in some cases, we're learning a lot from the data from these individual retail banners. So starting with, and some of this is also a function of our story, the chronology of how we've built the business. On the cannabis side, between the Spirit Leaf and Value Buds banners that you referenced, Spirit Leaf was the first acquisition that we made. This was back in July of 21. That Spirit Leaf is a both corporate and franchise portfolio that has evolved over time and has a more bespoke selection and category management approach. Value Buds is a discount retailer trying to plug into the key themes that resonate with consumers, which are really value and convenience. And if we hadn't made that first step foray into cannabis retail with the acquisition of Spirit Leaf, it's unlikely that we would have been an owner of Value Buds today. So that's been a bit of an evolution. As you're well aware, retailers in Canada on the private market side, must acquire inventory at the same cost from provincial boards. So there's no truly no unique supply agreements or real advantage to scale, and you'll set gross margin based on how you price product when you face the consumer in retail. In addition to that, cannabis retail in Canada is quite unique in that the marketing restrictions are so restrictive, and when you combine that with the lack of maturity on the e-com side, it means that really the only place to own the consumer relationship on the recreational side in Canada is at the point of sale in brick and mortar retail. So we think that'll evolve over time, but we're getting a lot of very interesting signals and data from our participation at scale in cannabis retail. And then on the liquor side, it's really two models I would split between convenience, which is sort of everyday best pricing, lower basket sizes, and high velocity products, and our wine and beyond model, which is sort of a selection as brand concept, where those locations are significantly larger. In many cases, they will hold north of 4,000 SKUs in a single store. So a little bit of a different model, but we found that we're taking share with that model from convenience managers, even in a modestly declining volume environment. And so clearly that sort of selection as brand opportunity resonates with consumers. And the challenges come down to managing the working capital aspects of that. As you can imagine, putting together that theater with that many SKUs has a specific capital intensity to it. And our team has done a phenomenal job of managing it.
Yeah, it's a broad portfolio sort of across the two different verticals. I want to dive into a bit more on the cannabis side, and the INDIVA acquisition seems to be a defining moment on the production side of the business. And what does integration look like, and how has it changed what you can offer on the product side of things in the cannabis market? And do you notice my own personal purchasing habits on your balance sheet when you talk about some of the brands that you offer? Because I buy them a lot, and I often buy them at Value Buds.
Well, we are tracking you, Jay, on a weekly basis. Rest assured, you better be a Rise Rewards member. If not, we should shoot the next segment in store, and we can sign you up.
Well, they know me and my dog at the Lansdowne and Bloor Value Buds for sure.
Perfect. But we appreciate your business. We'd love your feedback on the experience generally. I would say that you're right. INDIVA. It was a very interesting situation for us. That was a situation where we had actually provided credit financing to the company, and they just didn't quite have the scale to both exist as a top producer of edibles, but also incur the public company costs related to running that business. So we've consolidated it. We're still running the same plant in London. And the volumes are an interesting mix. We have our own brands being produced there, which include No Future, which has been doing quite well with the multi-pack offering. But we also have a number of licensed relationships, which is a really key part of our B2B model. In our vertical model, we have been the producer of products for all of the top LPs at one time or another in Canada. And so we're really working to be a great partner to industry. And if we have the ability to showcase phenomenal brands and products in retail, it is in certain cases a foray into additional manufacturing or development work on the product side with those companies. So you referenced the Grown Pearls, one of the absolute bangers in the edibles segment. We expect the edibles segment to grow continually over time from the small base it's at today. If you look at figures in the US in terms of market share, Canada should continue to, or the edible segment should take more of the pie in Canada, I would say. But we're producing both licensed products for top brands globally, as well as our own brands. And so there's quite a bit of synergy there. And given Canada's position as a launch pad for international trade, we see a great opportunity to bring those brands to the rest of the world with SNDL as a launch pad for that. And so another example of a licensed relationship, not edibles, but that's important and interesting for us is we're launching with Jeter in Q2 here. So we'll be the sole manufacturer of Jeter products, which have been really popular on the infused side. But I would say we're big believers in the edibles category. Excited to see innovation and further evolution of that category, and proud to be the largest producer of edibles in Canada at the moment.
And can I ask you a question specific to that? And it's very specific, is that this goes to the idea of regulatory changes can have a measurable impact to the business itself, I would imagine, and that we went from having relatively small dosage available to actually having much larger. I just bought my first, I'm calling it a box of pearls, or a pearl box, if you will, for the first time not that long ago. Like, how does that change the business measurably, or is it just sort of a great to have the option of putting together like a multi-pack or many more servings in one package?
There's a couple facets to this. That's a great question, Jay. That are positive and also negative, right? So, what it really does is drives a bigger opportunity for price compression, which is a massive benefit to the consumer, right? Which should be helpful in terms of mass adoption. And we know that the Canadian consumer is under pressure with current macro events around the globe. You're seeing gasoline prices. People are gasping as they see their next heating oil bill for their homes. So the cost of energy is extreme right now. We need that to abate. Some of these discretionary purchases do get challenged in an environment like this, and the Canadian consumer, as you know, has been hammered just about everywhere they go by inflationary forces. The rate of inflation in the grocery aisles is far greater than what U.S. consumers have experienced, for example. So we really need our government leaders to take action here. But otherwise, the packaging itself is the biggest frustration. So you'll be aware and familiar with the typical format on the edible side that you'd see in the U.S., which tends to gravitate around about 100 milligrams of THC in a single pouch. Tends to be 25 milligram gummies, sometimes 10. But that is a format that's loved by consumers and tends to drive about a 15% share of total market. In Canada, we have to pre-package those individual units to get to those multi-packs, and so the environmental waste that comes with this is extremely disappointing, and we need to continue to work with regulators for real common sense reform on these things, where we can benefit the consumers, but also the marketplace, and be good stewards of the environment as well.
Yeah, absolutely. I want to sort of shift to balance sheet stuff. And you ended 2025 with $252 million in cash, I believe, unrestricted cash, no debt, and exposure across Canada, US, and European markets. I want you to sort of think about, like, with a balance sheet that strong, what does a disciplined capital deployment actually mean in practice? And what are you looking for in the year ahead or days ahead?
It's a great question, loaded one. Look, first and foremost, we cannot take action and we cannot be competent stewards of capital without regard for our own internal cost of capital. And so it's critical that we're earning a rate of return with all of our activities that exceed that cost of capital. Being debt-free is a massive advantage in terms of being able to size up for the right opportunities and potentially take on some modest debt in the future for the right types of opportunities where we can avoid dilution altogether in terms of the issuance of shares and transactions. But in terms of that capital, as we noted with our Q4 and full year earnings a couple weeks ago, we were in, for the most part of Q1, in the market buying back our own shares. We have returned over time almost $50 million to shareholders, right? We've also made investments both in securities of publicly listed companies that we had an interest in, or outright, M&A, and I would expect that to continue. In terms of our priorities, we look at the continued development of retail in Canada on the cannabis side as a top priority. We are looking to invest in core markets in the U.S. that we have exposure to through our Sunstream vehicle, which enables us to remain compliant with NASDAQ for now, and then also watching very, very closely what's happening in terms of development of international markets. We're getting calls and requests for capital loans, equity contributions on a near daily basis from international operators. And so we are doing business, and we have a fledgling export business. I would say last year we did about $13.5 million in international sales, and so are watching really closely to see where the most competent partners are, and who we can work with to further develop that business. Ultimately, we'd be looking to verticalize our Canadian model into Europe, and that could come through multiple avenues. It is possible that we could actually gain a material footprint globally by making a Canadian acquisition, which may sound counterintuitive. And then there are also a host of opportunities internationally to look at acquiring. And we've seen 3 different transactions this year alone, in the European markets that have brought some buzz with them.
Yeah. I want to ask you sort of one last question, and you're dual listed, as you noted, here and on NASDAQ. What does that dual listing mean strategically, and how do you think about your investor base on each exchange?
It's a great question. I'm not sure I can answer the last part, but look, the way that I look at my role, one of the key components is to create optionality for our teams, create optionality for our shareholders. We want to have the ability not to put too much weight on any individual effort, knowing how quickly this industry is changing. Survival and value creation are really our North Star. And we will likely have to pivot on a number of different fronts over time to achieve those ends. And so being nimble and flexible are really, really critical. When you look at the motivation and logic behind the CSE listing, I would first ask that we take a step back and look at how the cannabis landscape is set up. It is, again, a real pain point here, real dysfunction. There's no other way to call it. You've got dozens of U.S.-based operators that are plant-touching operators, MSOs, et cetera, that because of the Schedule I status and lack of federal legality of these products in the U.S. cannot list on U.S. exchanges. We've had discussions right up to the general counsel office at NASDAQ. They would love to take this business. They're also not going to, even walk on a line when it comes to this until the coast is clear. They're not going to take action, period, no matter how much we hope and wish that it might be the case. And all these comments in the media about a fast follow for exchange listings post Schedule III, which hasn't even been fully confirmed yet. It's we need to really try to tune out that noise and not use hope as a strategy. But in our case, we have a compliant business. We're not an operator that is plant touching in the U.S. today. If we were, we would run afoul of NASDAQ restrictions and need to migrate off of NASDAQ. But what CSE does for us is it gives us optionality. And if a time comes when we want to be a truly North American plant touching operator with really a clean chain of governance, so that we're actually managing assets, not just supplying capital on a hands-off passive basis, then we have the option to do that. And so the CSE has been a phenomenal partner and a great means for us to create optionality for our shareholders and our business strategies going forward.
Well, I really appreciate your time today, and we look forward to connecting with you as time goes on. And thank you for being the first guest, Zach, on this program from the CSE.
Thanks, Jay.
Great. We'll catch up with you soon. Thank you for joining us for this first episode. Be sure to like and subscribe, and stay tuned for more from Cultivated and the CSE.